What is happening um, is a cycle that began in 1945. We began a new monetary system. The world created the dollar as the world's currency at the end of World War II. And then we began a debt cycle. And spending power comes from money and credit. And so central banks create money and credit. And we have the world's most powerful central bank because the dollar is the world's currency. And we began a cycle. And that cycle allowed more and more stimulation, but we accumulated more and more debt. And the ability to do that diminishes as interest rates get closer to zero, because usually they stimulate by cutting interest rates. And when the interest rates hit zero, central banks have to print more money and buy more financial assets, which they did in 2008, the way they did it in 1933. And then the economy picks up on that, and we create more money and debt. And then you have a downturn. Now, this downturn came because of a virus, but whether it came for a virus or for any other reason, it's an economic downturn in which the central bank has a limited ability to be stimulative. So think of it this way. Every individual, every company, every country has a certain amount of income and a certain amount of expenses and then a certain amount of savings. And when the income falls so that it's low, maybe even below the expenses, they have to dig into their savings. And so what we're experiencing now is, with a lot of debt, there was a fall in income that and a lot of people and a lot of countries and a lot of companies don't have an adequate amount of savings. And so that's where the financial crisis comes from. There are two kinds of inflation. There's the supply and demand inflation. In other words, when the demand for something is high and there's not enough of it, it goes up in price. And then there's monetary inflation. Monetary inflation means that you print a lot of money, and even though the economy can be very weak, you can have a monetary inflation because the supply of money and credit increases so much faster than the goods and services, even though there's not much demand for that. So it'll depend on which country you're in. All this printing of money and credit right now in the United States is to fill in holes in the balance sheets. So in and of itself, rather than causing a higher level of inflation in a place like the United States or Europe or Japan, what it's going to do is reduce a greater amount of deflation, and because it's just filling in those holes. However, we should talk about what is the value of money, what is the storehold of wealth. But when you get into other countries, that's not true. So they will have the printing of their own money. It won't be in much demand. And yes, there is a significant likelihood that they will experience monetary inflation, even while the world has a shortage of demand. These adjustments go on for relatively few years in the scope of things. Like, this restructuring process will probably take place over, maybe the next 3 to 5 years. And I know that's a long time, but it's not forever. And the human capacity to adapt and invent and come out of this is much greater.